I'm going to mention four things. The first is around early stage financing. And so even the enterprise supply development soft capital coming from corporates is not playing in the early space from, say, 50,000 Rand requirements to 2 million sufficiently. I think that there is a mismatch of capital requirements between investor and investee. So SMEs are requiring perhaps more patient time horizons. They're requiring perhaps concessionary terms on their loans, so maybe below market returns, especially in the early stage. Thirdly, I think that there's an issue with distribution, so the intermediation of capital. Do we have enough managers that are able to design investment that's fit for purpose? When we think about that type of role, we think about investment banks. How does this intermediary start translating the investor and investee needs and creating fit-for-purpose packages of support? And then finally, I think that there is perhaps a lack of life cycle support for the SME. So what you'll find is there's a handoff of SMEs between their early fundraising efforts, say family, friends and fools, to maybe be an angel investor, to perhaps an equity provider and then a debt provider. I think that there's a lack of coordination in the market. So every time an SME needs to go and raise additional capital, it's like they're starting from scratch. So those are some of the issues that we've identified. The thesis around impact investing or innovative finance more broadly is that we'd like to optimize financial, social and environmental returns. We think that there are positive or negative financial, social and environmental returns in any investment, and we want to be able to price those correctly. We want to be able to assess that risk associated with that investment more wisely, and so optimize those three elements. What that means for SME investing is that because it's a space that is perhaps lacks a track record, there is a lack of will to go into that space because there's perception around returns, that it's a perfect place for impact investors to play. And if I take it back to if we look at what my initial thesis around barriers were, if you think about, for example, distribution mechanisms. So maybe an investor or investee is used to taking on debt. Perhaps they've been trying to raise debt from the banks. Banks are really not happy to support uncollateralized lending. That it might be that intermediary can design some sort of a instrument that's better suited. It might be that they need to raise a blended form of capital to do so. So it could be that they're raising maybe the larger amounts of senior debt from an institutional investor or someone who's more risk averse, but at the same time they're getting softer capital from a government source or from a corporate source. They're blending it together. They're creating an instrument that investee feels happier buying into. And what innovative finance or impact investing brings to the market is a way for people to think differently around combining and distributing capital, to draw it into those hard to reach places. That's kind of how I see it in this area, yeah. One of them is Ashburton's, used to be Atlantic Asset Management. They've raised a fund, it's an equity fund, and what they've done is they've raised initially, I think 100 million from the Jobs Fund. What that enabled them to do was leverage that to raise 10 times that amount from the private markets, and that they spent on impact investments in the climate space, infrastructure space, social housing space, health, education, etc. They had a sort of a wide portfolio. They have gone on to raise an additional round of funding from the Jobs Fund. That's government money providing some sort of a guarantee. They haven't tapped into their initial guarantee, which is great. It means that they're getting the returns, their investors are getting their returns, and they've been able to leverage this additional capital from the private markets. I think that's a really great example of blending different forms of finance. I also want to mention another, I suppose, enterprise development funder that I know in the debt space. It's Pagamani Capital. It's run by a guy called Nick van Rensburg, who used to run Anglo-American Zemele Fund. I think that his investment thesis is interesting. I think it's replicable. I want to do more work to understand how it works. It is, I think it's slightly different to your enterprise and supply development funds, who are also doing a great job. People like Edge Growth, for instance, or Growfin or BPI. I think what he was doing differently was he changed the fee structure in his fund. He moved it from maybe a 2 and 20, I don't actually know what his fee structure, to maybe a fixed fee. His decision-making criteria, due diligence, was simple, it was quick. His turnaround time was quick. His investment sizes ranged from 4,000 Rand, okay, so incredibly small amounts to keep cash flow within small, but just keep them going. I mean, these businesses are viable, but they cannot go to the banks to get working capital. It's either they can't raise it or it's too expensive. And he was providing that kind of working capital facility. He was lending on the back of contracts. He was lending in very risky areas. He was lending in mining towns, and creating these enterprise in mining towns, not in sort of, peri-urban or metro township areas where there's access to market and there's access to support systems, etc. And he was getting an 80% repayment rate on that, which means that he had to go and find an extra 20% from someone who was willing to build these enterprises, pay a subsidy on it, but the economic value that was created would have, it just would have a multiplier effect. So those are the two, I think, the Pagamani and Ashburton's. We work along 3 streams. There's quite a big teaching component. We sit in the Graduate School of Business. So that doesn't only mean we're teaching the MBAs. We also run an impact investing course for wealth managers and wealth holders to take them from start to finish how to either start up a impact investing fund for a family office, or even someone who's sitting in, Coronation or Future Growth, etc. We run a fantastic doofrance, we call it. It's not a conference. In Joburg, Durban, PE this year, and Cape Town, obviously, that's where we're situated. We get thousands of early stage entrepreneurs in for a highly interactive sessions. We're not talking panel discussions, talking heads, long lectures. They are TED-style talks, they're interactive workshops, and they're one-on-ones with almost 50 speakers in each of those locations, specifically looking at access to finance for social enterprises and early stage or township entrepreneurs. So these are guys that don't necessarily have access to friends, family, and fools, but where can they go and start looking for the grant capital they need, the equity capital they need, the debt, and how do they understand that spectrum? So that's a teaching aspect. We also design and implement catalytic projects. So we look at the market. We have people who come to us, say J&J, or the Western Cape Provincial Department of Health, or Slum Dwellers International, or corporates, to say there's a particular issue that we want to solve. We design a financial instrument and we pilot it. So, for example, one of those is what we've called the Green Outcomes Fund. We're doing with Green Cape and WWF and the World Bank. It's a wholesale fund for green outcomes, so anything to do with climate change, renewable energy, etc. What would happen is that recipient funds, there's a fund of fund, recipient funds. The recipient funds can start drawing down grant capital when they start creating impact. And they can use that grant capital to de-risk future investments. So that's a model of monetizing impact, which is it's experimental, but getting a lot of interest. I work on an outcomes-based contracting portfolio, so we launching a few social impact bonds, designing an outcomes fund for girls' education, and then probably one of our flagship projects for the year, and I know this was a later question, but is the convening a national advisory board on social impact investing. So there, we've identified the size of the market. We know a lot of the players. We know that it's fragmented. And there is some coordination required in the market to make a step change in unlocking capital for impact. We haven't plucked the process out of the air. There is an international group, the Global Steering Group, that was spawned off the back of a G8 social investment task force in 2014. They're now going to be working with 11 additional countries, South Africa being the first in Africa, but a few South American, Argentina, Chile, Finland, Italy, China, India, so an array, different contexts. Impact means different things in those different contexts. What we want to do is attract public and private and civil society players onto a board for over an 18-month period to identify the gaps, identify maybe 5 key areas which we think can work at a sufficiently large scale or macro level to shift a sector, and then to constitute working groups around those 5 focus areas and take them forward and pilot them, or get the whatever policy revisions that are required, lobby for those and see if we can move the needle. I think that impact investors really, if I can be so bold as to say, want to work their way out of a job. So, in other words, if we can start looking at investments in a far more sobering way and properly price in the externalities. In other words, if you are creating this economic value, you need to price in environmental degradation into the cost of that production. Or vice versa. If you are providing, incredible social impact, you need to cost in your economic value that you're creating on a longer time horizon into the cost of doing business in that space. How do we do that? I think that you do it through awareness raising. You do it through creating a track record around mechanisms that starts to draw in capital. I mean, that's kind of what happened in the VC space. It didn't immediately take off. It took decades for it to take off. I think how the National Advisory Board can contribute to that is in the medium term. So really, it's going to be constituted and it's going to work over the short term, so 1 to 2 years. Medium term, I'd say 5 years is when we want to see some of these projects coming to fruition. We'll be looking at supply and demand side initiatives. I'll give you an example of a supply side initiative which has been used in multiple countries is unlocking unclaimed assets. So there are billions of rands sitting in banks and insurance companies that have gone past the statutory requirement of their needing to sit there and remain liquid if people need to draw them down. And we can put that money to use. We can build a wholesale fund that starts to build the intermediation space around impact investing and create awareness. On the supply side, on the demand side, I think we've got some fantastic examples. I think Barbara Creasy mentioned one of them, the Gauteng infrastructure project. I don't know the correct name for it. Looking at public-private partnerships. So how can we, these are what she's doing is she's creating investment opportunities for the private sector. Another really great example is the renewable energy independent power producers project, and not simply the fact that I think Karen Breitenbach has run one of the most successful procurement processes in the world, but the fact that that is a model that can be used to procure in different sectors, particularly around creating cost efficiencies and reducing the price over multiple procurement rounds. So deliberately phasing in the various kind of tariff structures. I think we've got a lot. Like there's so much richness to learn from in our country. There are pockets of excellence, and I think that we can take those to scale. What we'd really like are we're a university. We're a team of 6. We're a small group of players. There's some highly dedicated people that have been working in this space for years. Mark van Wyk, John Duncan, Heather Jackson. These Wendy Luhaba. These guys are pioneers. What we would like is we would like some champions from mainstream capital. We'd like some champions in the public sector. We'd like some champions in the pension funds. People that are willing to forego quarterly returns to help to both stabilize and grow the country.